Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of February 16th, 2025. And in this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take a look very quickly at a wrap-up of a Russell Index trade that I've had going for a while. It is finally done as of this week, and I want to recap that. Then I'm going to take a peek at two earnings trades that I put on this past week and what the setup was, show you the Flappy Bird chart and kind of the thought process of mine going into it. Then we're going to go ahead and wrap up with a new scalping strategy that Viper's been kind of experimenting with. And he'll talk you through a little bit of his thought process and the setup and what that looks like. But before we get to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888 where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's episode. And Viper, I want to touch on a trade. Actually, just last episode, we talked about even the losers get lucky sometime. And if you stick to the plan, you might come out ahead. And that's exactly what I did. And believe it or not, in the following trading week, the rest of that Russell trade was wrapped up and I was able to close it out, winner all around. In fact, this is one of the best Russell Index trades I think I have ever placed. So I want to take a brief look here at the outcome chart. This is similar to the chart I showed last week as far as how everything tallied up. This started off with two short puts, and you can go back to last week's episode and see my thinking on why I added the two short calls to basically have two strangles. I was able to first set closed out on January 31st was the expiration. The next set actually expired at the end of last trading week. I closed it out maybe 2 days early last trading week, and the first set on the 31st totally expired worthless, except I actually got assigned on the call side, so I was actually short a future, and just as luck would have it, it was very serendipitous that the following Monday after being assigned, the futures opened dramatically lower, like 4% lower. And so I was able to close that position out, that short future, actually when futures opened on Sunday, bagging an extra 32.50. And that is something that has never happened to me, that turbocharge. The rest of this earnings premium burn off is pretty common when I play the indexes. But the coolest thing about this whole trade was the fact that I actually returned about 100% of my return on capital. So the whole trade consumed about $7,100, $7,200 in buying power, and I was able to return back $7,300. Which is just phenomenal for premium selling. And so I just wanted to kind of close the books on that. If you want to know more about the setup and where I picked, go back to last week's episode because that's really where I talked about this trade in a lot more depth. Now, the other thing that I wanted to bring up kind of briefly here is the earnings setup. And earnings setup is something that I love to play. And what I do is I go into the screener and I look for earnings that are happening the particular trading week that we're going into. I look for what day the earnings are, and I am looking for earnings underlyings that are extra extended in volatility. So I want volatility very high on the historical range. And what that is that's not the spot volatility. So it's not the volatility that you see right now. It's the volatility that you see right now relative to the volatility range of the underlying over time. And the first ones that two of the trades that I took as far as earnings go this past week were ROKU and Palo Alto. And so I want to bring up the Flappy Bird chart of ROKU because I want you to see one of the real visual indicators of that extra volatility and what that gives you. So if we move over here to the Roku chart, what I've done is this is a super, super short trade. And so I put this trade on February 12th. The earnings are actually after the bell on February 13th, and the options expire on February 14th, the following day. So it really is kind of a one-day trade. And then depending on if we breach strikes, that's where we go into a roll or a management of the trade. Or I'll get assigned, which is something that might happen, and I'm okay. But what I want to call out here is this is the 4-hour chart of Roku, and the two red boxes here are basically my call strike and my put strike. So I have the call strike up here at about $95, and the put strike is down below at about $75. And what that gives me is almost a $20 range of movement here. That can happen after earnings, which is about a 10%. And you can see I've pegged this right about hey diddle diddle right down the middle. And so I got room for about a 10% upside move and a 10% downside move before I even am remotely considered for assignment risk. So I was able to collect a good, I don't know, $365 or something like that for each of these strangles, which for a move overnight is really, really huge. And then one of the prerequisites of this is I have to be okay with assignment. And so I'm okay going short Roku if we pop above this strike. And I'm okay going long Roku if we pop below this $75 mark. And that just really based on the larger price action and the earnings and that reversion to the mean, that even if you push through there like an elastic band, you're going to get some reversion to the mean is kind of what I'm counting on. But the amount of volatility contraction that's going to come out of this, because it was in the 70th or 80th percentile of volatility. So you just don't do this type of trade on anything going into earnings. You really want that extra extended volatility, because what that does is that pushes the width of where you place those strikes. So my strikes are about a 20 delta, but that 20 delta, if you don't have much volatility, is going to be a lot tighter. But when you have that extra extended volatility, your 20 delta is a lot wider of a range because there's a lot more potential movement expected. And so the other one that I also put on very similar to this, also extended volatility. Now, it was not quite the same of spot level volatility, and this is a great example. So before I switched over to the next one, I want you to know that the spot volatility on Roku was about 200% for the options expiring this Friday. And that's important because it was about 70 or 80%, I can't remember, historical volatility. And that is the exact same historical volatility that Palo Alto had, but Palo Alto was about 120% spot volatility. And this is going to show you, so remember here, we got about a 21% gap that we got to shoot the rapids down the middle. Now, if we look over at Palo Alto, it's still a pretty wide gap here, but it's only 17%. And the reason for that is because the spot volatility in Palo Alto was, if I recall correctly, around 120, maybe 125%. So it didn't have the same heightened spot volatility, but it had the similar historical volatility percentile, which makes it a valid thing to enter. Now, the one interesting thing about Palo Alto is that the bias in the strike distance was much more of a put skew. So this was a 20 delta, but you'll see I'm a lot closer to the top side than the bottom side, because the 20 delta was actually closer to the money on the call side and much farther away on the put side. And that's an indication of the market telling you that the market sees risk to the downside, which means there is more insurance premiums and stuff on the downside because there is a more anticipated move that is going to head in that direction. So a lot of times these earnings trades are very, hey, diddle diddle right down the middle as far as your up and down. But when you get skew, and you can get skew the other way, where there was risk to the upside, and you'll see that call. So a lot of meme stocks will have this, your GameStop, your AMC, where that distance to the call side at a 20 delta, if you have call skew, will be much higher, and the distance to the 20 delta put strike will be much less. So I just kind of wanted to put those up there, and we'll see how they pan out. Like I said, this is a 1-day trade, but it really fit that normal formula that I'm looking for here when we go into earnings of that extended volatility, and then shooting out there for that 16 to 20 delta strikes, looking for that extreme volatility contraction. So Viper. That was real quick on just kind of a recap and that stuff. I don't know. I know we didn't really share any of the strikes or those tickers, but I'm curious because you always pull up the charts on these things and you say, wow, look at that. Your strike that you picked there is right at this particular price action level or things like that. So I am kind of curious if I'm in the ballpark of something interesting.
So what does that mean for somebody like you? Well, down your two strikes here, 95 and approximately 75 here. That's looking really solid. Just like you said, you don't need this to hold forever. Ideally tomorrow. So a couple things that stand in your favor here are, one, the upside, 95. That's crossing through this battleground. So we're going to keep the green area here is a battleground because that is a range with a lot of liquidity in it because it's a key range. And so the odds, and nothing being guaranteed, we'll continue to harp on language of odds. The odds are in your favor that it's not just going to rip through here and keep going. So you have that defensive wall, if you will. The shield is up in this range here. 75 is probably your higher risk side, just because we aren't really getting traction to the upside yet in this range, but we are holding, and like I said, we are squeezing here. So now once again, going to those odds, the odds are still in your favor because on the daily here, nothing, and we're just squeezing in here. And so again, you're not in this long term, you're in this to cool volatility. So even though you don't have this big shield wall of a big liquidity range here, there's still decent odds in your favor that.
Yeah. The one thing I'll kind of add just to add a little commentary on my thought process here, that shield that you're talking about on the top side. Yes. If we were to break through that, what's one of the things of your confirmation of the uptrend that you come back down and test it, confirm that it's support and carry on. So, right. That's where I said, if I get assigned on the top side, there is a high probability that we're going to come back down to test that previous level there. And that's going to give me an exit point. Now, on the downside, where you talk about you're at risk on 75, right? This is my thought process going into that. Yes, I could get assigned. I could pay 75 to buy that shares. I would be long Roku. But where does your reversal of the uptrend happen? It doesn't happen at 75, right? We're in an uptrend, and you could still come back down to 75, get assigned, and still be in a continuation upward. So that's kind of my thinking on the downside as well.
Yeah, for sure. I mean, and just to visually show what you're talking about on the upside, I completely agree. Yeah, if we're breaking through here, first of all, if we break it in one push, which isn't impossible, but it is unlikely. But we did wick through here, so let's play devil's advocate. We cleaned out the liquidity, so resistance is going to be a lot less because we did have that wick push through there. So if it breaks through, then yeah, just like you just said, around a key range, once again, the probability is that we clear and then we come back down and give it a good solid test before we continue on to push for new local highs. Because there is, and I did not chart this, but I'll just kind of sloppily, but still in the ballpark here. There is technically a key failure range right here up at 100. And so, this bounce, I mean, even if we skied through that 85, 90, there is still, this is fresh. This is a fresh liquidity range here, a fresh shield that, just like we rejected off here, that's exactly the move you're talking about. That is, again, most probabilistic. If you skied through here, there would be another pullback similar to what happened down here, which is exactly what you're talking about, where it still gives you an out. Even if it breaks, then you still get that pullback. So So yeah, definitely. And then obviously similar on the downside, where it has to confirm reversal and then go. And there's just a lot of price. The price action of those reversals is dying volatility as well.
Exactly.
And that obviously plays in your favor. And then real quick, PANW. This is one of those charts I kind of hate. I did not chart it at this level, but we can kind of see, once again, just kind of haphazardly-ish throwing down about that is on the daily. This green is going to be, once again, that shield wall, where we are a little bit more in progress of the move through there than we were on Roku. We've pushed up into it. We've retraced a little bit, and we're testing the bottom side of that. And we're actively closing candles in this range, so it's not as firm resistance. Popping back to Roku, again, on the daily, much more firm resistance in here. We're not playing around in here with closed candles, but it is still a battleground. And so then lastly, tossing down your strikes on here, these red lines, the top one being your 210 call and the bottom being your 175 put. And surprise, surprise, a diddle
we
diddle.
will see how it pans out.
Doing that middle thing.
Yes, and I always find it fascinating how you go through this and they pan out to very similar to the price action levels.
The PA here is not what you base, and this doesn't just apply to this strategy. All strategies, whatever you're doing, find little data. If you can comprehend what's happening, find that confluence. Have your general thesis, drive towards your thesis, which is everything you talked about, how you open the trade, but then find elements of confluence and be careful. And this is just part of the learning process, but finding elements of confluence does not mean confirmation bias. You can dig in here and you could find whatever you want to convince yourself of whatever you want. So plug for the Discord. I think that's where not doing this alone and having a community really, really, really is the secret sauce, because you have your thesis, you're convicted of your thesis, and then the healthiest thing to get that confluence is to have exactly what we play out here on the show, have a third party give a completely different basis of a read and just see what it is, and it not for or again, it's just, extra data, which can never hurt. But again, your thesis has to be strong and convicted, so you don't start capitulating yourself around based on whatever anybody says. But soapbox, I get. Confluence and data points.
So Viper,
are key.
What is this scalping strategy that you've kind of been tinkering around with or talking through in your brain?
Yeah. So let's talk about confluence. So this is, I don't know. We got here by, once again, my ever restless leg syndrome, restless portfolio syndrome. I don't know. But experimentation and, I guess ultimately one way we got here was, scalping is interesting to me. So that's step one. I'm not forcing something that's not interesting to me. But step two, I've been doing, I've had some scalping sessions where I just do the price action. So everything I just did on the weekly, on the monthly, that analysis applies on any time frame. The 1 second chart to the 1 month to the 1 year, it's all the same exact thing. So I say that to say, in theory, if you have a very tight, firm grasp of that price action, you should be able to jump in to a 3-minute chart, a 2-minute chart, whatever, preferably 3-minute, but I said 2-minute because I want to excuse myself for where we head next. But you should be able to jump into a low time frame chart, do your price action, scalp, and you're scalping the swings, just like you're playing the swings on a much bigger scale, on a much bigger time frame. It's just all condensed. So I was doing that. not having the win rate that you want to have, not having the consistency you want to have. And so really what I'm about to go into was just my attempt, and I guess I have to be honest with some transparency of partially my attempt of like, can we make this any easier? Cheat code, that sort of thing, where fundamentally the price action thing should carry. However, this is sort of a side quest into, okay, if that's just not clicking for some reason, is there another way to make this click with using indicators and using tools and analysis tools by fully understanding what that tool is doing. And so that's kind of where we're at. So there's a lot to unpack here, so you don't have to understand all of it. What I want to portray here as we jump into the chart is I just want to portray the thought process, because I am by no means saying that this is perfect. I'm by no means saying that this works and this is, the thing, and it's evolving and whatnot. But the thinking behind it is, if something makes sense, but you're just not quite there, like the price action skill set is very much a methodic, and you have to do it over and over and over again. And I feel pretty confident on those high time frame charts. When it gets into these lower time frame charts, that's when it starts to fall apart. But it's also fun to scalp around. So a little adventure into, can we make that work? So nothing scalps. I don't want to say scalps more easily, but nothing scalps more 24/7.
There it is. I knew you'd bring up the crypto. Good job.
The crypto market. So we are looking at Ethereum. We connected it. So what we're looking at here is, okay, so we have this chart, and look at that. We're on the 2-minute chart, which isn't. There's a whole thing behind that as far as what time frame is best. But I was having success here, so consistency. But when we're looking at this, we're like, all right, and part of what I was talking about as far as the price action, like if we squint our eyes and zoom out, like absolutely there are fundamental price action setups here. We see this key failure here. We see a gain of it. We could wait for an entry right here, and then, we're off to the races. So that I'm kind of sending mixed signals, because that does mean that sometimes you just need to suck it up and stay focused on that. But nonetheless, what if it's just not clicking like it was, like I was struggling with it? And so what I was curious of is, we obviously have these chart indicators. Granted, indicators, it should be known up front, first and foremost, indicators are by their very default nature lagging. And so it's this conflict of they're lagging, the data they represent is outdated. And so they can't, there's just a lag there where you don't want to be lagging. But there's also the other side of the coin of, because they're lagging, they're sort of a smoothened, they don't have the ebbs and flows and the volatility spikes that the price does, because they're naturally more smoothened out. And so therefore we could gain a potential trend direction out of them. And so we could, so the general take here was, all right, can we use them and just kind of blend these worlds together, where I'm still doing some price action analysis on it, but then I'm also referencing these indicators just for some key pieces of information. I'm not relying on them, but I'm also referencing them for that confluence of, does this make sense? Team ABC, what do you say? And so there's a lot that's going to fill up this chart here. So I'm not going to go through and explain all of it, but I will try to use proper wording and labels for them. And absolutely go have a chat with ChatGPT or your LLM of choice, and just put in the, what is this indicator? Why is it useful? And all that sort of stuff. So the very first one is, all right, so there's this thing called a squeeze momentum indicator. Squeeze indicator, at a very high level, squeeze indicator is just a Keltner channel and Bollinger Bands, and a squeeze is on when the Bollinger Bands fall into the Keltner channel. And so there is this indicator called squeeze momentum indicator where we get to see the Bollinger Bands and the Keltner channel. So Keltner channel upside and bottom side is red, and then Bollinger Bands are on the outside. So fundamentally, all we care about right now for the purposes of scalping is what is the trend direction based on the Keltner channel and the Bollinger Bands. The bigger the width, then the more volatility is expanding. If the Bollinger Bands are expanding, volatility is expanding. And if we're riding a channel, then we're in a solid trend direction. If we're riding a Keltner channel, if we're riding a Bollinger Band channel, this is a very strong trend. And so, I mean, if I zoom back here, you can kind of see how that holds up a little bit here. We had this transition moment where we were like, kind of choppy, don't want to mess with it. And then once we cleared from the bottom of the channel to the top, we rode the Bollinger, we came down, we rode the Keltner, and we're just kind of ping-ponging currently between those two. So we're in a strong uptrend, which is great. One thing that I want to call out here, and I did this on multiple indicators that we're about to break down. Specifically, I called out, I was like, all right, so this is part of that confluence thing and bigger picture ideas. In the settings for this particular indicator, down here we have this time frame. And so it's what time frame do you want to calculate this indicator on? And so I'm on the 2-minute chart, but I said, give me the calculation according to the 15-minute chart, because I want to know what's happening above me, what's happening on the time frames above me. Is the 15-minute trending strong in a particular direction? If it is, probability in my favor that down here on the lower level, whatever's happening on the price action that I'm seeing, I'm going to see the next move before it shows up on the 15-minute, before it shows up on a lagging indicator. I'll see it in the price action on these 2-minute candles. But just, trend history, what are we looking at? And so I have found that doing this is very powerful to a lot of different strategies where you're looking at a lower time frame, but you pull context from a higher time frame. And again, you can't just do it blindly. You have to understand what you're pulling and why you're pulling it. So in this case, I'm pulling from the higher time frame because I just want to know what's happening up above me without flipping between the charts, to understand what's happening on the 15-minute and, is it strong in a direction or whatnot. So then kind of blowing through a couple other ones real quick, there was this adaptive common trend line, which, long story short, VWAP is volume weighted average price. So you could think of this adaptive common trend filter trend line as sort of a VWAP, where it's meant to be, we'll call it a fair price for the asset. However, this one is coded. It's built to adapt, as the name implies. It's built to adapt to market conditions. So if volatility goes up, it changes the calculation of the line. If volatility is down, changes the calculation. And so instead of just being a very linear average price like VWAP, this thing it just has a little more of a smoothing effect, but still takes into account market conditions. So we put that on here, and I'm going to explain these in just a second. Two other things that we put on here are, and I don't, I'll put them on here. So a 9 moving average and a 21 moving average. These are the ultimate of lagging indicators, as the name implies. They are a moving average over X number of previous candles in the past. And so of everything I just put on here, the squeeze indicator is based on the 15-minute. The 9 and the 21 are, again, based on the 15-minute. And so what I'm looking for on the 9 and the 21 is the crossover. If the 9 crosses over the 21, then up above us on the 15-minute chart, we have a potential reversal in play. And so again, down on the 2-minute, a reversal on the 15-minute helps us because it establishes a stronger trend direction that gives us more 2-minute candles to potentially scalp. So as far as, and then the other indicators down here on these charts down here, this first one here is the RSI, and then the green red band here, this is just an oscillator of the common filter. And so it's the same calculation as what the trend line is, but this is put into an oscillating pattern where down low represents oversold conditions, up high represents overbought conditions, but it also can indicate trend strength. And then a little hard to see down here at the bottom, this is just delta volume. And so all this is telling us is cumulative, what has the volume been? And so bringing it all together for a potential setup, we have the things that I look for are reversal conditions on the price action. And so that actually kind of kicks in. On the price action, it kicks in down here. So this kind of gets me paying attention. And then I don't really wait for the 9 and the 21 crossover because as you can clearly see, that's a very delayed event. Like by the time these confirm the crossover, we missed this gorgeous opportunity here to pop this. So I kind of use the MA crossovers there just as a confirmation of up at the 15-minute. This was a reversal event, and we are probability in our favor to continuing the uptrend. But then I also look for the common trend, which I look to cross over that. And then I also want to get some confluence here from the oscillator. I want it, if I'm going for a long scalp, I want the oscillator to be oversold. I want it to be low because then there's that mean reversion potential to pop and squeeze to the top side. So in this particular case, and then finally the volume delta, I want to see the volume, the delta of the volume that's happening to be in our favor. If I'm long biased, if I'm looking for a long setup, it wouldn't make sense if we see volume is constantly volume is constantly negative. So the sellers are in control. And if sellers are steeply in control, and there's price action indicating an uptrend, something else is going on, whether it's a liquidity grab and some, market makers are trying to push the price to liquidate positions or whatever. It's just not, it's part of that confluence of ideas. So hindsight is BS. And so the exact entry I would have taken here, it would be easy to say, oh yeah, you just do it right here at the bottom. But honestly, I probably would have been closer to when we first got most of our confluence. And so that confluence was the RSI here. You can see that the purple line flips. The purple line is the RSI. The yellow line is a moving average of the RSI. If the RSI is below moving average, that's a downtrend. And if we cross it, that's a potential reversal for an uptrend. So confluence-wise, for this particular scalp position, I probably, not probably, but I would have waited for the cross of the common trend line. And then that would have coincided here with the RSI flipping the MA, the RSI MA. We are in oversold-ish. It's not super low, but oversold conditions on this oscillator. And again, hard to see, but if I zoomed in, the delta volume is in a positive direction. So buyers are regaining control from when sellers had control of it. And so that's why I struggled with whether or not to put these MAs on here because, like I said, you clearly see when the MAs flip, we're well into this position. But it is a nice, there is some obviously price action off of the MA. as well. So that's the general setup. The last thing I guess I'd show is, again, that concept of layering on. So I did everything you just saw. I did that for a while. Was hitting about a 57 to 63% win rate. Fantastic. Risk to reward ratio was perfect. I mean, it was usually a 4-to-1 for the first profit target, sometimes a little more, sometimes extremely more, because depending on entering conditions, like because the price action indicated a reversal was happening here. So discretionary, but there wasn't full confluence here on this dip here. But if I was going to enter on this dip, absolutely my stop is right below this Keltner channel, because if we're going into a scalp condition, then there should be zero messing around with the Keltner channel on the opposite side of the position. We messed around with it over here. We got reversal. And so here I keep a super tight stop loss, and that enables sometimes an insane risk to reward ratio, which is, I think that's fair in a scalping condition, that risk to reward can be weighted so heavily to the profit side, and that's good, because if the more that ratio is in your favor, then the more losses essentially you're buying yourself. So one last thing, when I ran that, even though win ratio was pretty good, I was still struggling with a lot of false entries, where either I'd get stopped out or we would just waffle around, and I was like, this isn't what, truly capturing a strong market move. Like, I'm not saying it has to happen instantly, but sometimes I'd enter it and I wouldn't get stopped out, but we would just be lagging and lagging and lagging, just no real oomph. And I didn't like that, because that just feels like we're just a buoy in the water. I don't know, something. So the bit of confluence that really helped dial it in here was, once again, layering on another time frame, is up at the 1 hour. Long story short, I took a couple more indicators, average true range, ADX, and Bollinger Band width. And this was actually entirely a recommendation of GPT. So I did not come up with this idea, but PT did, and it was awesome. And long story short, if the orange lines are the moving average, the 50 MA, Bollinger Band width is just a calculation of how wide is the Bollinger Bands. And basically GPT said, throw the 50 MA on there. And if your ATR is above the 50 MA, if your ADX is above 20, and if your Bollinger Band width is above its 50 MA, then those are volatility favorable conditions. And for scalping, we want that volatility. Because you can see here on the 1 hour, all three of these conditions were met, and it is not a coincidence that all three of those conditions are met and we get this strong volatility move. We got this strong volatility move to the downside. And then continuing on up, we had yet another strong volatilistic, if the word, strong volatility to the upside. So I don't know. Maybe some of that makes sense. Maybe some of it doesn't. The main message I wanted to get across was just if you're trying to find what works for you, this is where absorbing what makes the machine tick, and then in the age of LLM, go wild with that conversation with a GPT or a Claude or Grok or whatever you want, because this was a solid setup. I set up the base play myself based on just playing with these indicators for a while now. Like I said, I threw it all at GPT. I said, here's my setup. Here's what I'm experiencing, working, but I'm also just getting some dead time. And then sure enough, it suggested that last little bit that really helped. So, not a strategy to copy per se, but hopefully inspirational to the idea of just, pulling little bits or pieces out of it and seeing if you can make them work for you. If not,
Viper,
cool. What else works?
I'm going to have to go back and probably play that again and again and again, because you dumped a ton of information and a ton of things. So I don't even know how to respond.
Yeah. Well, I mean, the spirit of it, I don't know. I mean, were there any indicators that jumped out,
I'll tell
or
you
any
the
data
one
points
thing that
of
stood
like,
out to
that
me,
makes sense,
aside from
and
a lot of things I need to go look up, was the principle of taking the you're looking at a lower time frame, but you're bringing in a time frame from a higher indicator, a lagging indicator from a higher time frame, but you're looking at the price action and the candles of a shorter time frame. I would say that was the thing that jumped out to me, because it's almost like you're plotting out the lagging move, but then you're zooming in to see the building blocks that are making that larger move.
Yeah, and I think that's an important, certainly of everything I spewed, like that's an area that I really want to highlight, because I personally think it's useful, because you have this lagging higher time frame line, which is not going to move very fast. And that's the point, that is like, it's like our shield wall. It's a range. It's an important line. And then using price action analysis, we can see if we lose it and then we test the bottom of it, we could be, it's a dynamic price range almost, if you will. Like, we can do price action analysis around this fixed important dynamic curve. And so, yeah, I think that was probably one of the key things for making this work, because all those indicators, when I put them on the 2-minute time frame, it just zaps, like there's just, everything is up, down, up, down, up. Like there was no clarity in the data. And then, at least for me, layering some of that in, and then still doing price action around those levels, that, I don't know, it was useful.
Yeah, so that brings us to the end of this week's episode. Real quick recap of, some earnings trades out there that I put on, and just the mechanics behind that volatility and that premium selling, showing you it's a single after single after single, and where the mechanics are, and why I pick the elevated historical volatility to give a wider range of, that price movement to move around as you simply wait for time to pass and volatility to contract. And then Viper hit us there on the end with all kinds of things to go look up. But the real takeaway, at least in my simple brain, was, that whole concept of, a lot of your indicators are lagging indicators and they're missing the actual move. Now, the price action is kind of the move as it is happening. And so taking indicators and charts from a higher time frame and then zooming in and looking at the price action on a lower time frame can kind of give you a little bit of your bearings, a little bit of training wheels there on the side is kind of what Viper's playing around with. And then just go back and watch his segment again, and probably pick up on all the different nuances and terms and stuff that he dropped. I there was a lot there, and I'm definitely going to have to go back, but I think there was a lot of good nuggets if I go watch it and kind of drill into some of those indicators, because they looked kind of interesting and I'd like to learn a little bit more about them. But that's really where I'd say go back and check that out. Otherwise, good luck out there. Hopefully you grabbed some interesting thing from this segment here. Something has perked your curiosity and you can apply it to your trading style and your trading strategy. And, the markets are becoming more and more volatile. We're getting whipsawed around a lot more, and that can bring a lot of opportunities for scalps, a lot of opportunities for premium selling, and just a lot of opportunities to short volatility. So good luck out there. And remember, think outside the block.